we've been talking about this Evergrande restructuring. Do you think that Evergrande is too big to fail?
Well, I think with Friday's announcement, that already answered that question. They have basically defaulted, right? So I think the government, actually announced policy easing after that default. So they have already entered into restructuring, so they're not too big to fail.
Yeah. It's a symptom of really a sector that's also slowing in terms of house sales. And what are your predictions on the housing sector next year?
Yeah, so property sector downturn is really a result of a combination of things. The fundamentals is slowing in terms of underlying demand because of slower urbanization and the demographics and so on, and also of course earlier policy tightening, and then we had the spillover effect from Evergrande. So even though the policy seemed to be easing at the moment, it's not going to quickly turn around right now. So we think sales will continue to fall probably by 20% or so for the rest of the year. We already saw a 20% decline in October, and early next year.
Is that a hard landing?
I would say it's not yet a hard landing, because I think if things can stabilize sequentially early next year, which is our expectation, so we then see housing starts and sales fall by maybe 10-12% next year. That's still manageable. If there is no policy easing and no stabilization, we could see 20% fall annual for the whole year. Then there will be a hard landing.
Well, theoretically speaking then, if you were to run a stress test on the economy and say what the impact, worst case impact would be on the banking sector and property, what is that worst case scenario drop in property that you think the system can withstand?
It's hard to say what's the worst, but I can imagine if, as I mentioned, if housing starts and sales drop in volume 20% for the whole year next year, and then property investment goes down by 10% or more, then GDP growth would be brought down by 2.5 percentage points. So that is pretty severe, and that will have a big impact on the financial sector, because the financial sector, about 50% of their loan book equivalent are exposed to property. So this would include property developers financing mortgage, but also a lot of loans that may be collateralized by land and property as well, for example, from LGFVs from other companies and so on. However, I think the damage to the banks will be big. However, we still don't see a systematic risk for the banking sector, because I think the government will manage that in terms of they were not let sort of a market clearing right away, right? So they can use regulatory forbearance. They can allow time for this bad debt to work out over time rather than right away.
It doesn't seem like this latest RRR cut is enough then to at least put a floor on growth at this point. Are you seeing more in this easing cycle now that we've seen this pivot? Is it LPR cut in the cards?
Well, so RRR cut is definitely a signal that the monetary easing is starting, and there are other easing. I mean, the more important than RRR cut is the Politburo's policy stance. Basically, they put stabilizing growth as top priority for next year. So we would expect not just monetary policy. So monetary policy, one RRR cut is obviously not going to be enough. There will be more liquidity offering, not necessarily in RRR cut. There will be also easing of credit policy, so that the restrictions on developers, on mortgage, on LGFV, on other sectors will also be eased. Support for SMEs. There will be fiscal easing as well, and property policies will be eased.
So that's the government spending part of the GDP equation. Let's talk about the C, consumption, because I mean, yes, they can cut rates, yes, they can bring it down. The economy does not respond in the same way that it did 20 years ago to monetary policy. Where do you see consumption next year, and do you see it continuing to be as weak as it was this year?
Well, so consumption recovery in the beginning of this year was pretty strong. I think later, as we saw more tighter restrictions related to COVID, and then the consumption recovery had slowed. So next year we face some challenges. One challenge is, of course, growth is slowing, construction activity is slowing. That will impact on employment. The other is we have the Winter Olympics in the first quarter, so we're going to see also tight restrictions. But after that, after the first quarter, we actually expect domestic restrictions to be eased. So zero COVID policy still stays in place, but I think right now local governments are adding much more to that, right? So we expect that to ease. So that will help release the pent-up demand on consumption. And to the extent all the policies we talked about, monetary, fiscal policy, that can stabilize growth, that can also help stabilize consumption and employment.
Well, if they continue on with zero COVID, does that mean when it comes to outflows, then it's pretty much limited, given just what we've been seeing with the renminbi these days? I'm just wondering, does that strength continue on for next year?
Yeah, so that's a good question. I think definitely there will not be much outbound tourists.
Yeah.
So the current account surplus will remain sizable. And also, I think the China still offers good yields compared to other places, and monetary policy is not tightening but loosening. So that could still attract inflows in the bond market as well. So indeed, we expect the RMB to remain relatively stable. A little bit of depreciation against the dollar, but relatively stable.
We'll leave the last question to you since it's the holidays. What are we missing? What are people asking you that we haven't talked about yet?
Well, I think the biggest question is actually on property, right? So what
okay.
more? And also, I think another important thing is on infrastructure. What are they going to do? So that's the, think of the energy shortage, think of the decarbonization effort. So definitely things like renewables and grid and, green tech, that's the area that will continue to see support and investment.
We've been asking our guests this. What's your biggest worry for next year?
The biggest worry, I think, is still going to be the COVID situation and COVID policies. As I said, we expect domestic policies to ease considerably in the second quarter. If it doesn't happen, then we see some downward risk.